India, a burgeoning global power, faces a critical economic challenge, managing its rising debt. This issue is not just a matter of numbers, but has far-reaching implications for the country's economic stability and growth prospects. As of 2024, the country's gross government debt stands at a significant $3.2 trillion, representing 83.1% of its GDP. This high debt-to-GDP ratio is a cause for concern among economists and policymakers alike. This figure places India among the top 10 countries globally in terms of debt burden. Being in this position means that India has to navigate a complex financial landscape to maintain its economic health. Furthermore, external debt has also climbed to $717.9 billion, marking a 10.7% increase from the previous year. This rise in external debt adds another layer of complexity to India's financial management. This situation necessitates a thorough understanding of the factors at play and the potential implications for India's economic future. Experts are closely monitoring these developments to provide insights and recommendations. The escalating debt burden is a complex issue with multifaceted implications. It affects various sectors of the economy, from infrastructure to healthcare and education, creating a ripple effect that can hinder overall development. It can impact a country's creditworthiness, making it more expensive to borrow money in international markets. A lower credit rating can lead to higher interest rates, further exacerbating the debt situation. This, in turn, can limit the government's ability to invest in crucial sectors like infrastructure, healthcare, and education. These investments are essential for long-term economic growth and social development. Therefore, it is essential to analyze the government's strategies for managing this debt and ensuring its sustainability. Effective debt management policies are crucial for maintaining economic stability. Understanding the nuances of India's debt situation requires examining its composition and drivers. This includes looking at both domestic and external debt and the factors contributing to their growth. A significant portion of the debt is held domestically, which provides some level of insulation from global market volatility. Domestic debt is often considered more manageable as it is less susceptible to external economic shocks. However, the rising external debt, particularly in US dollars, exposes the economy to currency fluctuations and external shocks. This can lead to increased financial instability if not managed properly. The following sections will delve deeper into the government's initiatives to address the debt challenge, comparing India's situation with other major economies, and forecasting its potential trajectory over the next 25 years. These insights will help in understanding the broader economic context. By analyzing these factors, we can gain a comprehensive understanding of the opportunities and challenges that lie ahead for India's economic future. This holistic view is essential for crafting effective policies and strategies. Recognizing the need for fiscal prudence, the Indian government has embarked on a path of debt consolidation. This strategic move is aimed at ensuring the country's financial stability and economic growth in the long run. The primary objective is to rein in the debt-to-GDP ratio, gradually reducing it to a more manageable level. This involves a series of calculated steps and policy measures designed to curb excessive borrowing. The government has set an ambitious target of lowering this ratio to 50% by 2031, signaling its commitment to long-term fiscal sustainability. This target is not just a number, but a reflection of the government's dedication to prudent financial management. To achieve this goal, the government is employing a multi-pronged approach. This includes a combination of policy reforms, expenditure rationalization, and revenue enhancement measures. One key element is fiscal consolidation, which involves reducing the fiscal deficit, the difference between government revenue and expenditure. This is crucial for maintaining economic stability and reducing the need for external borrowing. By narrowing this gap, the government aims to limit its reliance on borrowing, thereby slowing down the accumulation of debt. This strategy is essential for creating a sustainable economic environment. Another crucial step is the planned shift in the fiscal policy benchmark. This shift is expected to bring more transparency and accountability in fiscal management. Starting from 2026 to 2027, The government intends to prioritize the debt-to-GDP ratio as the primary indicator of fiscal health. This will help in better monitoring and managing the country's fiscal position. This move signifies a significant policy shift, reflecting the government's focus on long-term debt sustainability. It underscores the importance of maintaining a healthy balance between debt and economic growth. However, achieving these targets will require navigating a delicate balance. The government must carefully manage its spending while ensuring that essential services and development projects are not compromised. The government's plan to increase gross borrowing from the market to $171.26 billion for 2025 to 2026 seems to contradict its fiscal consolidation goals. This highlights the complexity of balancing short-term needs with long-term objectives. This apparent contradiction highlights the challenge of reconciling immediate funding needs with long-term debt reduction objectives. It requires a nuanced approach to fiscal management. Despite the challenges, the government's proactive approach towards fiscal management provides a degree of optimism. By staying committed to its fiscal targets, the government aims to build a resilient economy. By setting clear targets and implementing concrete measures, India is taking steps towards a more sustainable fiscal future. These efforts are crucial for ensuring long-term economic stability and growth. However, the success of these initiatives will depend on a multitude of factors, including economic growth, interest rates, and global economic conditions. The government must remain vigilant and adaptable to navigate these challenges effectively. To fully grasp the magnitude of India's debt situation, it's crucial to compare it with other nations. By examining the global debt landscape, we can better understand where India stands and what challenges it faces. In a world grappling with record-high debt levels, India's burden appears relatively moderate. This perspective is essential as it helps to contextualize India's economic health in relation to other countries. The global public debt reached a staggering $102 trillion in 2024, highlighting the widespread nature of this challenge. This astronomical figure underscores the severity of the debt crisis that many nations are currently facing. India's gross government debt, while substantial, represents a relatively small portion of this global total, accounting for just 3.2%. This indicates that on a global scale, India's debt is not as overwhelming as it might seem in isolation. This suggests that India's debt burden, while significant, is not as severe as some other major economies. Countries like the United States, Japan, and China have much larger debt loads, both in absolute terms and relative to their GDP. Furthermore, India's debt-to-GDP ratio, while higher than the global average, is significantly lower than that of several developed economies. This ratio is a critical indicator of a country's ability to manage and repay its debt. The United States, for instance, grapples with a debt-to-GDP ratio exceeding 121%, reflecting its substantial borrowing and spending habits, while Japan's ratio surpasses a staggering 251%. This makes Japan one of the most indebted nations in the world, highlighting the extreme levels of debt some countries are managing. Even China, with its rapidly growing economy, faces a debt-to-GDP ratio of 90.1%. This shows that even fast-growing economies are not immune to high levels of debt. These comparisons underscore the importance of contextualizing India's debt situation. By looking at the broader picture, we can see that India's debt, while significant, is more manageable compared to some of its global counterparts. While the country faces a significant challenge, its debt burden remains lower than many of its global counterparts. This relative position provides a clearer understanding of India's economic standing. This relative advantage provides India with some breathing room to implement its fiscal consolidation measures and strive for long-term debt sustainability. Effective management and strategic planning are key to maintaining this advantage. However, complacency is not an option. Vigilance and proactive measures are essential to ensure that the debt remains under control. The global debt landscape is constantly evolving, and factors like rising interest rates, geopolitical tensions, and economic slowdowns can quickly erode any perceived advantage. These elements can significantly impact a country's debt situation. Therefore, India must remain vigilant and proactive in its debt management strategy to navigate the complex global economic landscape successfully. By doing so, it can ensure sustainable economic growth and stability in the long run. Forecasting India's debt trajectory over the next 25 years is a complex endeavor, fraught with uncertainties. However, by analyzing current trends and considering potential scenarios, we can gain valuable insights into the country's fiscal future. Projections suggest that India's debt-to-GDP ratio is likely to decline gradually in the coming years, reaching 80.5% by 2028. This projected decline is encouraging, signaling that the government's fiscal consolidation measures are having a positive impact. However, even with this projected improvement, India's debt burden will remain substantial, requiring continued vigilance and proactive management. Maintaining this downward trajectory will require sustained economic growth, prudent fiscal policies, and effective debt management strategies. The government's ability to achieve its ambitious target of a 50% debt-to-GDP ratio by 2031 will depend crucially on its success in navigating these complex challenges. However, unforeseen circumstances, such as global economic slowdowns, geopolitical instability, or domestic policy changes, could disrupt this projected path. Therefore, it is crucial to consider a range of potential scenarios and develop contingency plans to mitigate potential risks. The next 25 years will be a critical period for India's fiscal health. By pursuing a balanced approach that combines economic growth with fiscal prudence, India can strive to achieve its debt reduction goals and secure a sustainable economic future. However, this journey will require constant adaptation, innovation, and a commitment to sound economic principles.